regulator lacks a level of sophistication that we need in order for us to get comfortable doing a structured finance or kind of a securitization off balance sheet bankruptcy remote type financing, which is our bread and butter, right?
So if you think from a multi-generational holding company asset, now is probably the best time to own, I think, emerging market equity if it's control equity or something that you're building.
Yeah, but specifically you've dealt with the ugly work of collecting. I've done it in my banking background where the guy you are, drinking beers with when you're signing the loan agreements, now he's not paying and you actually have to go and collect from him and you're no longer friends. And, it's something it does to you in terms of like just making you appreciate like how diligent you have to be. Welcome back to the F Square podcast, where we unpack what it really takes to build serious fintech in Africa. This week, we're taking a hard look at credit, not just a theory, but the nuts and bolts of what separates a backable lending business from one that breaks. Joining us are two people who know this space better than most. There's AJ Davidson, partner at Sixpoint Capital. They specialize in credit securitization and capital structuring. Sixpoint calls themselves advisors with a checkbook, and for good reason. They've helped scale some of the world's most ambitious credit platforms by turning assets into investable products. There's also Aum Thacker, investment professional at TLG Capital, a leading private credit firm deeply active across Africa. TLG doesn't just deploy capital, they've become strategic partners to lenders navigating macro volatility, regulatory complexity, and real-world scaling challenges. Together, we explore the full cycle of a lending startup, how to pick the right segment and the markets to avoid, what infrastructure is non-negotiable on day one, how to stretch early capital to unlock growth, when and how to engage with venture debt, and what it takes to graduate into securitization. Whether you're building a credit business or backing one, this is the blueprint. Let's dive into it. First of all, we are finally doing this. It's been like how many weeks of postponing it? But as they say, you can't keep a good man down. So, AJ, great having you guys on the show.
It's my pleasure.
Cheers. So, we did the article some time back. I think we did the private credit article in the newsletter. I got a lot of very good feedback from it. And actually, 4 founders reached out and said that the article really helped them think through their strategy. So 4 founders in the fintech digital lending space. So you guys are doing good work. You're doing God's work. Keep it going. So I thought it'd be important to now put this on a podcast format, have the discussion, and probably this could bring out a bit more nuance than an article would. So that's why I wanted to have this discussion. And we could probably go now straight into like the core thing. And, from the article, it was very clear that market selection is a very important thing. And particularly, maybe AJ, you can take this. We've seen Move growing significantly. M-Copper has exceeded 400 million ARR. I think Watu is also making quite a bit of progress on that side. They just financed.
Move's another one.
Yeah, there's Watu just financed their 3 million phones. And so, what should founders think of in terms of market selection? Like, what's the right market segment? And specifically because it seems like from when you're building a credit business, there's a broader ecosystem fit. Like your product also has to fit into like what the funding markets, what the capital markets actually want. What kind of infrastructure is set up to support this kind of market. So like, what are the core things from like a market selection that if someone sends you a deck and it's talking about a specific segment, you won't even look at it. But when it's talking about the segment, I actually want to have this conversation. Maybe AJ, you can take that.
Yeah. That's great. So just before we get started, let me just give you for your viewers and listeners just like 30 seconds on who we are. Yeah. So my name is AJ Davidson. I'm the co-founder, CEO, and CIO of Sixpoint Capital Management. We focus only on exclusively on emerging market and frontier market private credit. We're a private credit investment firm. that also exclusively focuses on structured credit to fintech lenders. Our platform is designed to support high growth, driven models with asset-backed warehouse lines, local currency solutions, and real-time risk infrastructure. And we work very closely with founders to not just fund loans, but to help them build systems, structures, and safeguards that allow them to scale responsibly and attract long-term institutional capital. So with that in mind, to your point on segments, I think that, we lend to fintechs across Africa, LATAM, MENA, and Asia. And the one thing is clear, don't lend where you can't get repaid without a judge.
Yeah.
Okay. So we look for repayment enforcement built into the model, like asset disabling, revenue control, and platform lockout.
Yeah.
That's why we lean towards models like Move and MCOPA, where the assets is both income generating and recoverable.
Yeah.
That's not to say we don't do unsecured deals, but particularly in more high beta African-based jurisdictions, we would tend to favor asset-heavy transactions over unsecured transactions. We pass immediately on any decks where enforceability depends on a moral obligation or a legal process where there's no leverage.
Yeah,
if your borrower can ghost you and nothing happens, that's not a lending model. That's charity, and so that's not something that we look at.
Got it. I like the whole judge analogy there, and it's important because if you look at even models like Fuliza, there's kind of inbuilt enforceability because they can switch off your line, and you don't want your M-Pesa line switched off. And so it seems like there's it's a common thread across most people who are doing well on digital.
Yeah, I mean, there's a bunch of different models like that. I mean, we're working with a company right now in Kenya that provides financing for for consumers to buy mobile phones.
Yeah.
And they have a direct relationship with the mobile phone telco carrier. So in the event of a default, that phone completely goes dark.
Yeah.
Another model is also in Uganda and Kenya. And we've seen it now. We've seen this model pop up in other jurisdictions, Tanzania and elsewhere, is financing of mobility financing, similar to Move, right? Yeah. So the equivalent of Uber drivers. That's an easy one for us to take a look at. And then fast moving consumer goods, trade finance.
Yeah.
Is also something that we look very, very closely at, particularly in sub-Saharan Africa. It's a burgeoning market. It's completely underserved, and returns and yields are juicy. And there's also collateral, that we can take a look at.
The underlying goods, great. And it's for you, Aum, it's like at this stage, it's pretty early stage, right? And so you'd think that the micros matter more than the macros, and in terms of like what AJ mentioned, like recoverability, the types of industry and everything. How should someone think about macro risk at this level, especially for you as a kind of big picture investor?
Sure. Maybe I'll also quickly introduce myself. So Aum here, I represent TLG Capital. We're a fund that's been around since 2009, 2010. We've done more than 40 transactions across the continent. We only focus on Africa, and we invest out of our Evergreen fund, which is mainly commercial capital. Our second fund, which was launched this year in April, backed by the IFC, by the Norwegian government, the Swedish government, the French government, and a number of family offices. And then also, to partially answer your question, out of our local currency funds. And so macro obviously matters, and there's been a huge amount of dislocation, and it's not helped that if you think from an allocator perspective, Nvidia's beats earnings every single quarter, and Meta was at 120.
Let's hope they do it again this quarter, because I'm long Nvidia.
And so, exactly from an allocator perspective, these markets have mainly been rounding errors as a portion of their global portfolio, especially when we talk about Africa. You get that through Frontier. You get access to Safaricom through the MSCI EM index, not by the Kenya index, because no one buys that. And so when you look from market to market and you allocate the way that AJ do and we do, one distinction is obviously that we can look at companies and holding companies and all sorts of stuff. So we don't just do fintech or technology. And there, I think the macro has been an opportunity, because if you look at big corporates that have EM exposure, like Nestle, Danone, Diageo, Sanofi, etc., these guys are carving out their Africa operations. I mean, Tolaram, which is a Singapore-based, it's an Indian family in Nigeria, basically, they bought Guinness in Nigeria. We just funded a platform that bought Old Mutual's insurance business in Nigeria, that's buying Heineken assets in Nigeria. So if you think from a multi-generational holding company asset, now is probably the best time to own, I think, emerging market equity, if it's control equity or something that you're building. If you think from then a trading perspective, right, because AJ and myself, we're not necessarily thinking about multi-generational capital allocation. We're thinking about getting paid every quarter.
Every month.
Every month, there you go. We're every quarter, maybe twice a year if people are nice to us. But there the macro obviously does matter, because there's a dollar return that we need to realize. There's a dollar IRR, and the further the currency slips, the longer your IRR is going to take to catch up at the back end. And so number one, what we consider is match your liabilities to your revenues, and that's why we raised a local currency fund in Nigeria. That was the first ever private debt fund in Nigeria. That way we can go to local pensions that are sitting on local currency and invest that into local assets. From a dollar allocation perspective, the big thing, I think, is to what extent is the productive activity that you're funding effectively part of the inflation basket or part of something that is essential to people. So to AJ's point about funding an asset that is productive, or funding an asset that is income generating, or funding something that is not just consumer credit for 30 days, but it's an asset that's all used. I mean, this is why we just announced in Kenya, in your home, Samora, we just did an education deal, because I don't think people are going to stop paying their kids' school fees.
Exactly.
And that's the last thing that goes away. And any increases can be tied to the essential part of the consumer basket. So that's
I mean, from our perspective, macro absolutely matters, especially in the types of markets we all work in. I mean, at Sixpoint, we actually just started lending in local currency and hedging at the fund level before we were doing dollar lending and expecting dollar back, and having our portfolio companies do the hedging at their level. We're now taking the operational complexity off the founder's plate, which is important, because most early stage platforms don't have the tools or expertise to manage FX exposure responsibly. But let's be clear, that doesn't eliminate the macro risk, it just shifts it. So the hedge cost still flows through to the borrower via local currency pricing. So if a country's FX volatility is extreme, then the all-in cost of capital becomes, in certain cases, unworkable, whether the hedge sits with us or it sits with them. There's still countries in sub-Saharan Africa where it's effectively a no-fly zone for credit because of capital controls and hyperinflation, or unavailable or expensive hedging markets. That said, we're actually trying to build some solutions. We're not as ahead of the game on the local currency funding channels that the TLG is, but we are, in the coming months, we plan to partner with some local currency banks to raise local currency leverage to our fund against US dollar denominated fund capital. And that will remove a little bit of the FX hedging overlay, because we can use, it provides a natural hedge, and that should, we'll pass that cost savings on to the ultimate borrowers, making all-in pricing more sustainable and bringing debt capital to markets that desperately need it. But inflation is a huge issue in sub-Saharan Africa. Currency controls is another huge issue. Not everybody can be TLG that has a local currency, local domiciled funds that raise locally, deploy locally. It's very unique what TLG has done. But unfortunately, TLG it has only limited amounts of assets under management, and the demand for credit is far outstrips what TLG can provide, and there needs to be more players in the market. So,
and each market has a different regulator, right? So we
exactly
the SEC and Abuja that doesn't take us anywhere in Kenya.
No, you're right. I mean, and from what I pick from that is that there's kind of like a limited opportunity set in terms of the countries you can invest in, because you need like stable macros, and a bit of an at least advanced enough financial system that can support, some things like hedging.
And a supportive regulator.
Exactly.
And a supportive regulator.
Exactly.
And the problem that we faced in certain jurisdictions that I'll go unnamed, but we faced this recently. The regulator lacks a level of sophistication that we need in order for us to get comfortable doing a structured finance or kind of a securitization, off balance sheet, bankruptcy remote type financing, which is our bread and butter, right? And it's been very challenging in certain jurisdictions. It's taken months to cut through bureaucracy and red tape with local regulators that are meant to be promoting foreign direct investment, and by extension are not, because they're sitting on their hands or not doing what more developed markets, or dare I say even more advanced emerging markets, have already embraced in terms of allowing more sophisticated structured credit, private debt investors to come into their markets and provide foreign direct investment through those means. But we have seen in many cases, both in the East Africa region as well as in the West Africa region, regulators just not get it, and it's caused us in the last year to have to pause deals that we were very excited about, and that's unfortunate because that's directly the responsibility of the regulator. It has nothing to do with the credit quality. It has nothing to do with the macro. It's just the regulator is just not being supportive.
Well, that's a very interesting point, because something that a founder needs to keep back of the mind, that you may tick all the boxes and still the deal won't go through because it's beyond you. But now, speaking about the founding team, one thing about like lending in general, as opposed to investing, especially equity investing, is that it's a negative science. You're trying to avoid mistakes as opposed to trying to make big wins. And a negative science requests a specific personality and a specific set of team skills, kind of work together. What do you look for in a founding team? And the reason why I framed it like that is because you can have the most enthusiastic, high energy person, but if it takes too much risk, it's not good for you guys. So what do you guys think of, like, when you're looking at the founding team, and especially what core elements must exist for you to get comfort?
And you want to go first?
Sure. Thank you. Look, I think for me, it's you have a lot of founders that get into this game because origination is a great business. And you look at the big outcomes. I know that some of these have valuation issues in the States and so on, etc. But if you can originate credit, then you're not traded at book value. You get a multiple of revenue.
Yeah.
And if you're a founder and you know how to structure and raise money, well, why start a bank when I can have this thing that's valued better?
Yeah.
And so you get lots, and I'd love to hear what you think, AJ, after this. But I think there's loads of capital markets types who are good with their Excels, who have the roster of people that they need to reach out to, that think I can raise 1, 2, 3, 400 million and originate this credit easy, but they don't think about the actual day-to-day collections. And the people that I've met and the founders that I really get on with are the people that have been like out there when people haven't paid, and they've had to turn up and figure it out, and they've had to reconcile really boring Excels where things don't work, and you've got it doesn't matter if it's using AI or data science. Of course, you'll get those tools over time, but it's people that have looked through a loan tape with 1,000 rows and seeing what's worked and what doesn't, because they've actually felt the pain. Whereas if you get someone that has a nice suit and knows the right people in Miami and New York and London and Paris to raise money from, and has this amazing idea, if I can wrap this in a nice in and put it onto the exchange and whatever, I think that person's going to have an amazing pilot. They're going to raise a really good pre-seed, but as soon as your loan grows from 500K to 5 million, default's going to spike.
Yeah.
AJ, you've been smiling. You've been smiling.
I'm smiling the whole time because there's a lot of alignment there. I'm actually going to take it a little more extreme. And be a little facetious. So an immediate red flag for us is if the founding team is made up of all McKinsey ex-consultants or the same type of people. With no disrespect to McKinsey. we back founders who live in the data. If you can't tell me your 30-day or 90-day roll rates or how your first-time borrower defaults are trending by cohort, you're not ready for institutional debt, period.
Yeah.
The best founders we've worked with obsess over repayment behavior. There's an old adage in credit. It's really easy to put money out. It's very hard to get it back.
Yeah.
Founders that know their collection challenges by borrower segment, their recovery curves by geography, and that they revise their credit policy on a periodic basis. That's what we're looking for. Now, the other thing is there are, there's things called the traditional 4 or 5 C's of credit. I won't list them. Your users can Google them, but the one that we pay close attention to is character among those C's. So we look for actually humility and collaboration in our founders. So at Sixpoint, we actually call ourselves advisors with a checkbook. We pride ourselves on working closely with our portfolio companies to optimize structure, FX risk, documentation. But if a founder can't work transparently, that partnership just won't scale. It just won't.
So super valuable feedback. Have we lost them?
No, we're still there.
Okay,
good. We got it.
Good, because you all went quiet and I panicked a bit. But anyway,
now,
so now
I made my point and then dropped my mic, basically, as they say.
Got it.
No ex-McKinsey consultants that don't have any background in credit. That think that we've seen. Unfortunately, we saw a lot of that in the first wave of fintech lenders. I know Aum is smiling because he's seen the same companies. These were, a lot of but it's funny because the second wave of early startups now have gotten the joke, and we're seeing really, really better quality founders in this second wave of early stage startups in the fintech lending space in Africa. Guys who came out of other fintech lenders. Guys who were X branch, X Tala, that kind of thing. And they cut their teeth on something like that, or they worked at a large commercial bank and then they decided that rings, that's interesting. Guys who were, in the consulting space and can put together a polished deck, but have never actually underwritten a loan, don't know anything about collection practices. That's not going to get us out of bed in the morning.
Exactly. And
I think Samora as well, on this point of character, I think that's it's really, really powerful. And I think something that's important for your listeners to understand is from where we're sat, right? When you look at the NAV of our funds, and I don't know how we all do it differently, but the fundamental idea is if you lose money on a position, you're screwed because you're not going to have the same power law that you have in VC, where 3 investments return your whole fund. As far as creditors think about banks, insurance companies,
we care about losing $1 of principal. We don't care about you becoming a unicorn, right? So it's a completely different mindset, right? And if we get founders in the door who try to pitch us like an equity fund, first of all, that's just, it means they don't have any experience and understand how we look at things, and that is a little bit of a yellow flag right away. But we care about downside risk, and we want founders to have already appreciated that before we get in the door, because it's a lot harder when you're going through a diligence process to try to instill that in a founder group that has only raised money from equity and has no experience. Either raising institutional debt, or they don't come from a credit background, so they don't also have that mindset like, hey, if I'm putting money out the door, I need to know that I can get it back, so I care about downside risk. So in theory, if I'm raising debt, those guys are going to be asking the same thing that I'm going to be asking, so I know what to give them.
Exactly. And
it's just the same in the use of for proceeds, right? To me, the biggest slide that's going to be different in your equity deck is you can have this that probably normally looks the same. You have this circular chart, and you say this much is going to a team, this much is going to geographical expansion, this much is going to whatever. None of that is what you should be raising debt for. And I think people come and they raise credit for the first time. And of course, it makes sense. You want to recycle the slides that raised you so much money at such a great valuation. So you put that presentation out there. But it's your team are creating a return on equity, but that salary is not generating interest, right? And so where are you putting the capital that has got a cost, a contractual cost with escalation provisions, with amounts due at periodical, at certain times? Where are you putting that into something productive that's going to pay back? And I think that's really
this is actually a really interesting point that has raised as well, because another red flag that makes us kind of say thank you, but you're not for us when we talk to founders is when they come to us and they say we're profitable. And then we say we're unit economic profitable on our loan, on our lending. And I'm like, oh, okay, let's walk through that. And we find out that they're not implying a cost of capital in their unit economic waterfall because they've been funding their loan book with equity.
From equity.
So because they haven't implied it, they haven't implied a cost of the equity capital in that kind of unit economic analysis. And then we look at it and we're like, do you not understand that unit economics, you have to imply a cost of capital, whether it's equity or debt, and obviously equity should be the most expensive capital in your cap table. But if we start to layer on top the debt, the pricing on your loan is negative. Because and then they turn around and they say, well, can you price this cheaper? And we're like, well, no, we can't, right? Like there's a risk adjusted pricing that goes into this. Have you been doing risk adjusted pricing to your end borrowers? Well, no, we've been pricing it so that we can capture market share from our competitors. Whoa.
Red flag.
What's the rationale for that pricing? That's I'm using equity to buy market share. That's not risk adjusted pricing that would be commensurate with a credit centric lending platform. And that is an immediate red flag. We're like, thank you, but you're not for us.
And so it seems like, unlike most other domains, and this is mostly for the fintech audience, unlike most other domains, credit is the one area where you need, number one, some domain expertise, right? The second thing, you need to have some kind of credit background. Specifically, of course, there's a nuance, some of the things you've mentioned, but specifically, you've dealt with the ugly work of collecting. I've done it in my banking background where, the guy you are, drinking beers with when you're signing the loan agreements, now he's not paying, and you actually have to go and collect from him, and you're no longer friends. And it's something it does to you in terms of like just making you appreciate like how diligent you have to be. So credit is the one area where like domain expertise, discipline, credit background matters more than if someone is building a payments app and it's like, market share matters, grabbing market matters, but not necessarily in credit. But now moving now into the underlying infrastructure, of course, you've figured out the market, you figured out the team, everything looks good. The macros are working. It's a market in which, Sixpoint can write a check and keep scaling that check up. But there's your underlying infrastructure. I assume some people come and show you, look at our app, look at our UX. But for you, and maybe we'll start with AJ, what are you looking for in their tech? Like, what's the thing that matters? What are the few things that matters? Like, guys, if you don't have this in your tech, then you're not really a business. Like, we can't take you seriously.
Yeah. I mean, I'm going to have a couple of mic drop moments today.
That's why we brought you here.
There's another one. So if your first 100 loans aren't underwritten like a test pool for future securitization, you're behind. So you need timestamp loan level cash flow.
Can you break that down into like just like?
I'm going to. You need timestamp loan level cash flows, audit logs on every disbursement and repayment, version control credit rules, structured portfolio tracking, not spreadsheets. If we go into a platform and they're tracking their loan portfolio on a Google sheet, that's a big red flag. Okay. The other thing is like, we're not alone in this area. My friends at Lendable, former colleagues, and there are others who operate in sub-Saharan Africa as well. We're tech-enabled private credit investors. So we have our own proprietary technology. We have to be able to plug into the platforms that we're financing. We have our own proprietary technology tool that allows us to monitor in real time loan level data and collections. And we also work with an external data agent company called Cascade exclusively, Cascade Debt, and we have an integration with them. And so if you don't have clean data or you're reconciling manually, we can't move to term sheet. That's not punitive. That's fiduciary duty as far as I'm concerned.
Yeah. Any thoughts about that? Or is that an area that you don't?
My perspective is going to be slightly different just because we don't have the same capabilities to do what AJ and Lendable and these guys do. Like, we're not data scientists. We don't have those APIs that go in, but we also lend to different companies, right?
Right.
I think AJ will be lending at the project level, whereas we might consider something at the holdco level. And we're more sort of legal and structuring. And I think our role, if I do it well and we do it well, our role is almost to do whatever, investment bankers in Europe and the States do for large cap clients, where they help them with identifying a target to buy and then give them the leverage finance to do it. Right? That's what we do. We're advisors to companies from the strategic level, and then we provide custom funding packages, mainly to sponsor-led businesses. A lot of what we do is also ecosystem building. So, I mean, I think it's fair to say that banks in emerging markets do not have the capabilities or capacities to do a lot of this EM fintech lending. We work with banks to look at a lot more of their old school books. So you'll see us doing agri, manufacturing, and right now we're doing telecoms, and we're doing a palm oil and a soy oil producer, etc. That all being said, I think what AJ is saying about credit and data giving you an edge is really important. Because it doesn't matter where you're lending, you can mitigate and eliminate the risk of fraud by building stuff in there yourself. What you never want to be in a situation is where warranties and representations are coming to play from a business. Because you're there and they say, "Hey,"
by then it's too late. By then it's too late. It's a melt. It's like a piece of melting ice at that point, right? Like you don't like.
You basically made a bet. Sponsor, do they like you? Are they going to pay you or not? And that's not what I think any of us are paid to do. And so what we do. Sorry.
Sorry. Go ahead. No, go ahead.
What we do with our traditional businesses is we always have an initial 60 or 90-day value creation plan. And so we come in, we enter because there's a structure we're comfortable with. So by the time we've wired the money, we know we're not going to lose it because there's a bank guarantee or there's a property or there's some security, etc. Fine. Then, instead of asking the company to set up a certain form of data, someone flies down to the factory, because these are old school businesses with like real things happening, and we set up their inventory management software, we set up their accounting software for the first time, etc., etc. And so we've had, let's say, 30 or 60 days of, let's call it open risk, but actually no, because we've deducted the interest up front and we know that our principal is safe. Here's where we earn our equity kicker, or the upside that we're going to get. And so we're really proud to have partnered with Manufacturing Africa. They're sponsored by the UK Foreign Office. They bring down consultants like from McKinsey, BDO, etc., at no cost to us or the company. I guess at a cost to us because we're taxpayers, because it comes out of there, but not really from the P&L of the business. And I think it's exactly what AJ said. It's being an advisor with a checkbook. It's being able to create the equity value. And especially for us, given that we have recourse to the business and we're lending to the business and we're not lending to a specific project, I think it's investing the time in them. And I know, AJ, that's what you do during due diligence anyway, right?
Oh, yeah. I mean, like I said, advisors with a checkbook is sort of our informal. We have one informal tagline at Sixpoint, advisors with a checkbook. And then our formal tagline is powered by people, led by data, right? So that's like that's us.
That's what I want to know.
Sorry?
What do your borrowers call you?
I don't know. I mean, well, no, I think it's funny because during a due diligence and an underwriting process, I mean, like when we kick off a deal, I have a standard speech that I give to, during the kickoff call. And part of that speech, I typically tell the founders, I promise you that by the end of this process, you're going to hate me. You're not going to like me. But I promise you in about 6 months or 12 months after we close, you are going to look back and thank me. It is like going through boot camp, like military boot camp, to do an institutional debt deal for the first time. Many of these guys have never done it before, and they don't know what to expect. Equity raising is a completely different kettle of fish, as they say in England. And it is a debt raise, particularly structured credit, securitization in particular. It is not for the faint at heart. And we try to put our arms around the platform. We try to remind them that we're on their side and that we're advisors. But I can tell you, battle fatigue definitely sets in.
Yeah.
And it's not uncommon that we'll get within 2-3 weeks of the closing, and everyone is just exhausted.
Yeah.
And then they're like, and it's just common. It's just unfortunate. And so that's why you asked me, like, what do people call AJ? It depends on where we are in the life cycle of a deal. We have a transaction closing in Colombia this week. It's our first deal in Colombia, and the guys in Colombia, they hate me. They absolutely hate me. But I didn't ask me again in 6 months' time. They'll probably say they love me. So it's a different story.
Yeah. And it's interesting.
And by the way, the shareholders who are on the board who have signed up on the deal, I'm sure that they love you as well, right? So it's just unfortunate.
Oh yeah, because look, the bottom line. I mean, we're very niche. We're not as broad. We don't have a broad investment mandate as TLG. In certain cases, I envy that because it allows them to be really creative, constructive when they get opportunities. But when we started Sixpoint, our investment thesis is that fintech lending, particularly in emerging markets, is a securitizable asset class, just like it is in developed markets. And there's a massive dislocation in capital markets, and we want to try to help promote that asset class as eventually a securitizable asset class. That means getting our facilities eventually rated by rating agencies. There's a South African ratings company called ARC Ratings that that would be perfect to set up a range criteria for fintech lenders in sub-Saharan Africa, and we've been having conversations with them. And the idea is that the securitization market more broadly is the largest, most deepest, and liquid capital market in the world. It's like 10 times the size of other markets, whether it be private credit, private debt, equity, and everything else. And it's obviously the most efficient market in the world too. And so it's not going to be long where you see in certain global emerging markets. I mean, you're already starting to see it in places like there's 2 companies in Saudi, for example, that I think will probably be the first pure, CLO ABS transactions that were derived originally from early stage, from fintech lenders that only started like 5-7 years ago. There's probably one in Indonesia that's coming pretty soon as well. And so we're starting to see that manifest itself. And the same holds true for sub-Saharan Africa. There's really no reason why you've got globally within emerging markets, the World Bank has estimated $11 trillion of credit demand and a lack of formal credit. And that's not going to be met by traditional banks. That's not going to be met by, just TLG and Sixpoint and Lendable in sub-Saharan Africa. That's going to be met more broadly. And so how do you get those guys in there? You have to come up with, basically a structure that's going to be recognized globally by large institutional investors, and that's where securitization comes in ultimately.
Maybe, cool. And if you don't mind, just a very quick thing on that, because I think that's really important. Because it's very easy us sitting here and saying to founders, here's what you do to raise debt, here's what you don't, etc. But what AJ has just said, I mean, that's the equity opportunity, right? That's why people go into this thing, because that's where you're going to create.
Well, think about all. Yeah, I mean, you think about it also because you said equity. Equity investors in our portfolio companies are super happy. Of course, they're happy with us because if we structure this the right way, we can achieve 10-to-1 leverage against equity just in the loan portfolio, right? Which is different from TLG in the way that they structure their deals. There's a lot of cash collateralization and so forth, and that we are trying to, get somewhere where the loan portfolio stands on its own credit quality, and it can be limited or even non-recourse to the fintech lender.
Yep.
That is ultimately what securitization is meant to be doing, which is exactly what banks do in developed markets. I mean,
that's the key point. It's exactly
that's
the
key
point because
Yeah.
I think for us, and it's a great point you make, AJ, because I think what we're doing now a lot of is, and what I love about credit is that it's tradable and it's sellable. And we're doing this right now with emerging market banks. So where we were trying in the past, I think AJ and I would speak to the same companies, and our credit criteria wouldn't quite work the same way that yours would, because it was a little bit more flexible and you can get more leverage. We're now just going to banks and we're using their loan book and their portfolio to do portfolio level trades, which, by the way, are bread and butter and what people do all day long in Europe and the States, to trade bank risk. And I think the fact that, the founders listening to this, or the people coming into this, can recognize that for us, we're trying to make a market for bank risk in Africa, which is not actively traded, just goes to show, if that's meant to be your, risk premium of zero is the country, and on top of that slightly is the bank, everything on top of there has just not even been thought about yet. And that's where the market is to win.
And we'll come to that. We'll come to that because we're gonna dedicate a bit of a section to securitization, at least introducing a big chunk of the concept. But what I want to go to next is, now we're still at the early stage of we're still looking at decks, we're still getting that stuff getting off the ground, and I'm thinking about, like, a founder probably starts with like a family or friends round or a small equity round, and is trying to maximize that. So someone has raised, let's say, $1 million. He's got an idea about motorcycle lending in Tanzania or something like that. And when he comes to you, and we'll start with you, AJ, and he's probably done this for 3, 6 months, 9 months, let's say. Like, what's the thing that he needs to, hit off the park? Like, this needs to work really well. Like, are you looking at the level of repayments? Are you looking at the margins on the lending? What is the one thing that, when you look at this, I'm like, this looks impressive. You've done this thing right.
Yeah. So we actually work, we like working with early stage startups as well. We like to get in early. We've just launched a new product called a pre-securitization access program, or PSAP, which is basically it can be up to a $2 million bridge that helps them scale their loan portfolio until they meet the minimum requirements for our flagship asset-backed loan securitization warehouse line that starts at 10 million. So we this is we have these conversations all the time with founders. So what we commonly tell them is, like, we don't deploy your money like a bank. Deploy it like an R&D lab. Okay. It's important to run short tenor, high frequency loans. Iterate credit rules every 2 weeks. Build your loss curves by segment and track everything. We love to see founders reporting discipline early. Investor updates, vintage reporting dashboards, and a CFO mindset, even with like the first 50K out the door. That's what makes the next 5 million much, much easier.
Got it. Any thoughts about that? And the key thing there is that, of course, you need some kind of portfolio quality, but it's more around the operating discipline. How did he track the first loan out the gate? What kind of metrics was he monitoring? Was he iterating on his credit rules? Do you have kind of the same perspective on that very early stage lending and what you need 100%. To get right?
Look, it also depends on how people originate pools, right? How are you doing your customer acquisition? Are these like random people scattered all over? Or probably you've got one like B2B2C partnership, right? So every cohort has come from the same source. And I think that the problem, and by the way, it's a wonderful thing, it shows the passion of founders, is like someone can wake up in the morning and I think they could tell you like most of their borrowers, and they could find out where on a map they are, and they could tell you how much they borrowed and how much they pay back, etc. And that's incredible, but it's just not going to scale. And every person that you hire is by definition not going to have as much equity as you, and probably not going to care as much as you, and they're going to be on a salary and so on, and they're not going to have that level of recall. So I think a lot of it is building systems, and I can't speak to which softwares you use, etc. But the most important thing is, if someone's 90 days past due and it's your first ever cohort, you're just going to think about collecting it. But you should also think, hey, that's 90 days past due. That probably has an accounting implication. Should I consider this part of my write-off book? How do I think about this, etc.? It's about thinking for scale, because making, even though you can make a very high, nominal amount of interest in some of these segments on a small loan book, and that profit looks really enticing and juicy at the beginning, that's not your equity story. That's not why you're getting valued at 20, 25x. It's because you're earning a 21% net interest margin, because that's going to go down over time. And you're going to scale and you're going to grow into new segments and you're going to want to be an originator. And the way that you work or where your equity value comes from is somewhere completely different. And I think there are now, and I think this is a wonderful time to be a founder, because there are so many public companies out there and so many success stories and so many case studies across developed and emerging markets that you can already see the type of business that you're going towards, and you can see how they report to their investors. And so even if you're starting at the beginning and you're just like, hey, I just put some equity out, I want to get it back, having that in the back of your mind is probably really important.
Cool. Yeah, I'll give you one anecdote. When for us at least, supporting the whole run short tenor, high frequency loans, and iterating your credit rules every couple of weeks. If we see a platform that says, hey, I'm trying to disrupt a particular loan market, and I've devised this credit product, and it's a 36-month loan, and we're like, okay, that's great. How long you been in business? Oh, we've been in business 7 months. I have no data to go on. Your first cohort has not repaid. Right. I think a lot of founders who particularly don't come from a highly, from a more sophisticated credit background lose sight of the fact that of a very fundamental equation in credit: expected loss equals probability of default times loss given default. It's very important. How do I run an expected loss curve if I don't know what the probability of a default would be, and I don't know how much money I'm going to get back in a default scenario? And so, some of these companies are great. I mean, there was a company that we looked at. They were doing medical loans for plastic surgery and dental procedures in a market where there was a very high demand, but the tenor of the loan was like 36 to 48 months, and they were 7 months old. And they came to us and they said, "Will you lend to us?" And we're like, "What are we lending against?" Again, easy to put money out, hard to get money back. So that's why we think and why we try to have conversations with early founders. Why we try to work with early founders and also pre-seed and seed stage VC funds, who we have a lot of friendships with, and they know us now to refer us early on, is you want to be building repayment cohort history quicker. Because the quicker you do that, the quicker we can underwrite. Right. And we actually can underwrite quicker than most. Because we know what we're doing. But that's a prime example of what if you're trying to maximize early capital, that's what I would be doing.
That's a very valuable point. I mean, statistically, you need your sample size to get bigger, to get more comfortable, and the faster you do it, the faster your sample size grows. And then at this point, someone comes to you, AJ. I've done everything right. I've scaled to 5 million. I know my probability given default. I've built my systems. Everything is working. I need to scale this to like 20 million before we even get into the complexities around scaling to 20 million in terms of securitization. Like, what are the key hires now that you need to get right at this stage? Right? You probably
so
have a nice founding team. Yeah, just proceed.
Yeah, so the one key hire I would not recommend is hiring a capital markets person.
Okay.
Because we see that see that often.
McKinsey types, Excel sheet types. I mean, I don't know. Your career prospects are looking bleak.
With no disrespect to people who do capital markets, I mean, I also own and run a capital markets advisory business alongside Sixpoint. And you can hire external capital markets advisors and so forth. But hiring an internal person to focus on capital raising for debt doesn't make any sense when you have limited resources. We look for three critical hires. We look for credit data analysts, so someone who can model loss rates, segment risk, and simulate trigger events. We look for a clean slate with yield recovery and digital repayment experience. and last but definitely not least is a financial reporting lead or controller. Someone that is a very critical one for us. Like if you borrow under a facility and you have with covenants, you must produce monthly financials, debt compliance reports, and gap aligned P&Ls. And no funder is going to accept Excel chaos. Like it's just not going to happen. And again, if you've got a founder group that are with, again, I keep bashing McKinsey, but it's a proxy for a broader subset of humans. If that's your founder group, and you don't have and none of that founder group have that skill set, those would be the three critical hires we would look at before stepping in the door.
Yeah, and it seems to be a recurring theme that you need people who've been there and done that, like people who know what running a credit business looks like. And this is just something that you can't escape. Do you have anything to add in terms of like, when TLG is advising, because you also advise companies like at this stage when it's scaling, like what are those kind of key hires that, or just largely the same as AJ?
I think this is where what's really important, and I think it's not something we've spoken about as much, is what your relationship with your investors are like, which investors you've chosen, and how you're reporting into them. Because I think at pre-seed, if everyone's asking for a board seat because they want to fly to your HQ every quarter, doesn't mean you give it to them. And I think you can sometimes be surrounded by too many cooks, because lending, I mean, to be honest, it's a very simple business, right? You have a cost of capital, you raise liabilities, you put them into assets that generate more. If you do that, you're laughing. And that's great. Now, and the team that you require, as AJ said, is not overly complex. I'd maybe throw risk into the hat there as well. I think showing that you can manage risk is important, but collections is super, super important, because what you see, and I think we know a number of businesses that do this, and this is a multi-billion-dollar opportunity, is when you look at the larger scale of things, and you look at listed businesses, etc., their write-off book, I mean, it's the same as in oil and gas, right? End of life wells. There's someone who's going to buy that at a discount and collect everything from it. And so collections, and you can do that, and you can maximize your return on equity. And you can say that even if you have the NPL rates as defined by 90 days past due as the rest of your sector, which is fine, but you can juice that out and get some write-backs over time. That's free equity. And getting someone who can do that, who feels empowered to do that and can deliver that, is really important. And I would repeat the point, and I think it's really, really important that getting your reporting in order is really important if you want to have other people put their money into your business. If you're yourself and you want to be happy with it, then do whatever you want. You can have a black box, right? It's fine. But if you want other people to put risk capital into your business, and worst of all, people that expect it back, as opposed to people who are happy to be there for the ride alongside you and trust you and know you and love you, etc., then you're putting yourself into a position. And I maybe shouldn't say this in a podcast, but I think very rarely have we ever enforced on an informational default, right? It's not something that lenders always do if they're getting paid on time, but you're never getting a second facility, right? People are going to let this thing pay out. They're going to make sure they're going to get paid back. They're going to squeeze you. They're going to press you. They're going to ask you if you've got the right team around you. It's a very small community. Everyone knows each other, etc. Which is not putting yourself in the right position.
No, it's such valuable insights. Now, I think let's get back now into securitization. AJ's bread and butter, right? At this time, potentially looking at scaling this to $10 million, right? But it seems to me that, securitization is not something that just is pliable across. Like there's some things that need to work. Your portfolio needs to look a certain way. Your receivables need to look a certain way. The underlying assets need to look a certain way. Otherwise, the whole model breaks down. So AJ, could you just tell us what, the very basic level, what securitization is?
Sure.
What can and can't be securitized, right? Like, do specific business models just break down under securitizations? And are there any kind of implied assumptions around securitization that simply might not work as well in Africa as they would in other markets? Maybe you walk us through that.
Yeah. So, I mean, just to keep it simple for your viewers, securitization has been around since the 80s, 1980s, not 1880s, 1980s, but certainly long enough. Uh, it is effectively you're just converting receivables into a structured investment product. That's effectively what it is, and you're moving them off the balance sheet of the receivable originator, so that you can evaluate effectively the standalone credit of the receivable away from the operational risk and credit worthiness of the originator. Now, we still evaluate the creditworthiness of the originator because they stay in as the servicer of the receivable, but that's a separate evaluation. And one of the key benefits of a securitization is if you actually do it correctly, you can apply a higher level of leverage to the underlying credit of the receivable and have that be separated from the leverage that an originator might be able to raise on its balance sheet for things like working capital or other business lines. So it's meant to be a very efficient tool, and particularly for companies who have an embedded finance initiative alongside other revenue lines. Securitization makes a ton of sense because you're basically parsing the risk out to different risk takers. In order to do securitization, and this is where the advisors with the checkbook comes in, because we don't expect founders to know what they're doing here. We do this for a living. There has to be what's called SPV isolation. So you have to have a special purpose vehicle that is isolated or bankruptcy remote from your fintech founding company. We need the real-time performance data, and we need to be able to effectively obtain local legal opinions on the enforceability of the securitization structure, and also to make sure that the way that we've structured this achieves what's called bankruptcy remoteness. So what that means is, if the startup company, which is the loan originator, which also acts as the primary servicer of those loans or receivables, because it can be trade receivables as well. Anything that's cash flowing, basically, any asset on the balance sheet that's cash flowing is securitizable effectively. If that entity were to go bankrupt, it would not freeze the cash flows of the receivables that have been financed off into the SPV. That is a fundamental tenet of any sort of securitization. The moment that can be achieved, then we can start underwriting just to the credit risk of the receivable itself, away from the credit risk, the bankruptcy risk of the originator. And that's where you ultimately want to get to. In terms of what's securitizable and what can't be securitized, again, it's really, any sort of cash generating verifiable receivable that can be, taken and off balance sheet and put into a special purpose vehicle and can be bankruptcy remote is securitizable. And we actually at Sixpoint, we kind of pride ourselves on being creative around securitization structures. So, I mean, bread and butter is direct loans, right? Consumer loans, SME loans, that's easy. Trade receivables is sort of an extension from that. But we've even looked at platforms in Africa, actually, of, subscription-based models for financing of consumer goods. That's a deal we're hopefully doing in South Africa right now, which is really cool. We've looked at in the creator social media community doing, there's a couple of platforms in the United States called Grin and Maverick, and there's a couple of replicants that are popping up in a bunch of emerging markets where you got a bunch of social media influencers, and they get campaigns from the likes of Dannon, Diageo, and Coca-Cola. So that's the receivable you're facing. Is from blue chip companies that are paying social media influencers to do campaigns. We can securitize that. So there's a bunch of different things there. As long as it's a verifiable cash generating receivable, it's securitizable.
One thing I wanted to ask, and so assuming you have like someone who's lending SME finance, right? Like just trade finance, like FMCG. like, here's a 60-day loan, buy stock, sell it, and pay me back, right? So
Yeah.
you've got these receivables.
We love that. We love that. We're doing 2 deals in that space right now.
So the point I wanted to get at is that I want to understand the whole thing of like bankruptcy remoteness and like separating the originator from the underlying receivable. Because you have a situation where this guy is, this company X is servicing these loans. If they go bankrupt, what do you expect to happen in terms of like the continuation of servicing these loans, the relationship, the underlying relationship, and those receivables?
No, that's all. That's super critical.
Yeah.
So that's super critical. So there's a concept called a backup servicer, which is effectively a separate servicing entity that stands in the shadows, waits in the wings, is collecting the same collection data in real time as the fintech that's staying as the primary servicer of the loans.
Yeah.
And so in the case of a bankruptcy of that originator, the backup servicer can step in almost immediately. It's called a substitution event, and then effectively the backup servicer is there to do an orderly wind down of the portfolio. For all intents and purposes, and for your viewers to understand, if the originator goes bankrupt, we're not originating more loans from that originator. We're in wind down at that point. And so again, going towards the broader principle of that credit investors carry about losing a dollar principal, when we set up these securitization, we have a pack of asset portfolio performance covenants that also have various financial ratio triggers that allow us to, if you breach any of those triggers, that allows us to take certain precautionary or protective measures to potentially self-liquidate the portfolio even before an originator were to go into bankruptcy, right? We're trying to avoid that. But I do want to go back on one point in particular. In Africa in particular, we have faced some resistance from local African regulators on doing off-balance sheet bankruptcy remote securitizations, which just, you find it really goofy, frankly, because regulated banks and these member states of the Basel Accords, right, where Basel, the Basel guidelines for banks have chapter and verse on rules and regulations related to securitizations, and banks do securitizations, every day. And for these regulators to turn around and say, we're not going to permit our fintech lenders to do off-balance sheet bankruptcy remote securitizations, it just doesn't make any sense. And this goes back to the point where if we can't get comfortable that the regulator is going to support the bankruptcy remote nature of our financing, we can't do a deal in that country. And that's very unfortunate.
Is there a reason given to, I think let me just understand if there's a reason given as to why they are not supportive of this kind of structure.
I think it's frankly lack of sophistication. To be fair, I think it's, I think ultimately that's it. I mean, we pointed them to the Basel guidelines that they as a member state have signed up to. They're signatories to the Basel guidelines, but they haven't yet, in certain jurisdictions, published local rules on securitization. I mean, let's be clear. Kenya, which is a jurisdiction that a lot of people finance, they only publish their own securitization rules in the last 6-7 years.
Yeah.
So it's not. I mean, that in itself is not uncommon in sub-Saharan Africa, but there are other jurisdictions that where the bank regulator just even touch it. They're just like, this is too complicated. We just want our fintechs to get direct lending, and that's right. They don't understand that there are structured. I think some of the concern also is like, well, if you take it off balance sheet, does that mean that we lose supervisory rights of the loan portfolio or the loan originator? And we've gone back to them and they're like, no, you absolutely do not. And there are also structural alternatives within securitization. You can do a true sale securitization. You can do an assignment and pledging of collection rights. that technically leaves the asset on the balance sheet, but the collection rights for the receivable goes to the SPV. And that is in most cases respected in the bankruptcy proceedings. And so if a regulator turns around and say, we don't want you to move the asset off balance sheet, we want to keep it on balance sheet, and we go back to them and we say, that's fine, we can do an assignment and pledging of collection rights because that works under your bankruptcy law, which by the way, we can point to, they still put their hands up and like, no, we don't want to do that. And we're just kind of like, so it's just unfortunate because this is stifling foreign direct investment in certain countries in Africa right now.
And you wanted to add something to that.
Yeah, I think it's important to. So, I mean, firstly, obviously, echo everything that AJ said. I think the same with us with securitization. We were very pleased a couple of years ago to fund a film producer in Nigeria, right?
Yeah, that was a great deal. That was a great deal.
We're still doing it. We're on our ninth utilization right now.
Yeah. Amazing.
And OJ in London, the Swiss private bank, they participated in that deal. And it's the first deal they've done in Nigeria or in Africa, but it's Amazon risk at a premium, which people can get their head around.
Yeah.
And I think it's really important, I think, for, if there's anyone listening to this that's thinking, well, why would I start a credit-enabled business and have to talk to people like Aum and Samora and AJ and, why would I go through this hassle, etc.? The key point when it comes to securitization is when you think of the equity story, if I'm really good at lending, right? If I can raise money and put it out there and earn a spread on it, what am I going to become? And well, one outcome is you become a bank, and you can look at Axis Bank or GT Bank or any of these banks that are African banks that are listed on an exchange, and see even the best ones will trade at 1.4 times their book value, because at the end of the day,
that's a really good valuation.
And that's a good one. Most of them are half book. I remember Union got acquired at £7 a share. That was 0.5 book.
Yeah.
So these things, you're getting valued against what you're raising, your shareholders' funds, and what
publicly traded large banks are like sub one times book, right?
I think only Zenith and GT sit above one in Nigeria anyway. And the argument in theory, and this is why what AJ is saying about some frustrations on the regulatory side, the argument in theory is, okay, well, if I'm a bank, that's not good because I'm getting traded at a multiple of my equity, and also I'm a bank. I'm looking after grandma's deposit. The central bank's going to be after me. I need to maintain a certain ratio. There's all of these things I need to abide by. If it turns out I'm really good at originating credit, then not only does my valuation immediately re-rate because I'm being measured on something completely different, but in theory, the regulatory costs and the regulatory burden should go down. And that's what makes this such a beautiful business or sector to build in. Now, the demand is also from different folks. If you look at what's happening right now, Klarna, I remember it was amazing in London. You could put your burrito on Klarna, and the joke was, well, that's now a tradable asset class somewhere. Someone's sitting on a collateral loan obligation that's, burritos and pizza and all that kind of stuff. By the way, who's the buyer of that? Probably a pension fund in the US. So you think about regulation and you think about who's buying stuff. And I think the biggest secular trend that's changing right now that I personally cannot wait to see unfold in emerging markets is you go to Nigeria and Ghana, and long-term liabilities, which is pensions, insurers, etc., are sitting on 80% government bonds. Now, this is short-term, very revolving low risk. There's political reason why, sure, but at the end of the day, the banks are doing that anyway because their loan-to-deposit ratios are low, and the central banks only care about making sure that, if I'm being generous, grandma's deposit is safe, so put it in something that's low risk. But then where's the engine of growth going to come from to, in a continent that's going to double in population, et cetera? We all know the statistics in the next 20, 30, 40 years. Where is the capital going to come from? And I think the answer to them has to be these long-term liabilities. And by definition, they're either going to be investing in people like us, right? Alternative fund managers, et cetera, or they're going to be investing in the stuff that AJ originates, which are, instruments and securities and tradable things. And so I think it's really important that we get this right. And I don't think maybe some regulators will be listening to your podcast tomorrow, but I imagine
maybe I'll make sure I'll forward them to some. I've got some ideas of who I'm going to forward this to.
I'll tell Terry. I'll tell you offline which regulator specifically you should forward it to.
Cool.
That's why this thing matters.
Yeah.
It's because people need to make sure that they can build and get that outcome, and the market.
Well, I mean, yeah. Look, there. With all due respect and reverence to central bank regulators throughout the world, of whom I've spent a fair amount of time with, both in my current life and in my former life as an investment banker covering financial institutions globally. They have, in most cases, a dual purpose. They have to obviously protect deposits and protect the sanctity and the capital, the stability, the financial stability of their banking system. But they're also charged with supporting foreign direct investment. And I think, unfortunately, somewhere along the way, that latter prong has been subordinate in this respect. And so we'd like to see that. We'd like to see that change.
Great, and that's really important. I think the key insight there, and I think both Aum and yourself said it, about just supporting growth and the fact that Africa is still so young, and a lot of these people need to get into business, and capital has to come from somewhere. But now, like when you're advising some of these businesses as well, in terms of your credit business, and you're looking at the broader ecosystem, because there's a financial ecosystem that includes bankers and everything. What are the key relationships that a founder needs to build? Especially as a credit first founder, do you need to have the central bank governor's number? Do you need to be friends with the CEOs of all the largest banks? What kind of relationships do you really need to nail, and why? Maybe we can start with you, Aum.
Do you want to go?
Sure.
Yeah, Aum, do you want to go first?
Yeah, sure. Thanks. So I think, look, the basic infrastructure is really important. Like I remember a couple of years ago when this whole Silicon Valley Bank thing happened, and everyone was migrating, especially all the African startups are migrating to Mercury and moving to Brex and all that kind of stuff. Like, it sounds dumb, but like, make sure you can make payroll, make sure you can send international transfers, make sure you can pay your lenders, etc., etc. Getting your basic infrastructure right is really important. Because, I mean, and there's a saying on banking, right? Banking is about liquidity and it's about solvency, and nothing else really matters. You need to be able to make payments on time, especially if your business is taking and receiving payments from other people. That's really important. Regulatory relationships are very important. I think, especially when people start with an idea, it's very easy. And if you're an investor that likes catching people out or whatever, you just get to say to them, is it even legal for you to do this? And lots of people don't know the answer. So making sure that you know exactly how you're classified by a regulatory regime which changes. And by the way, normally in these markets, in most markets, when you see regulatory changes overnight, most of the banks tend to be prepared for them. Why? Because they've been told about them. So making sure we're in that room.
Well, and they've also been consulted. So in most cases, those regulatory changes go through a consultation process where the bank has the ability to respond to draft regs and things like that. It may not be the case for fintech lenders, and obviously certain fintech lenders are not technically regulated by the central bank. That's just actually there's a wave of re-regulation happening in sub-Saharan Africa right now for fintech lending. That where these businesses are starting to come under the purview of the regulator for the first time. I mean, we saw what happened in Kenya, right, where all the fintechs had to scamper to get a license and get and get that sorted, and there were a couple of fintechs that missed the deadline. And it causes problems, but that's all of that's new right now. For us, getting ahead of the curve for founders. It makes sense. You definitely want to be talking to a regulator before you hit scale. You want to document your onboarding, your KYC, your collections, and your disclosures. You want to treat compliance as a feature, not as a burden. Okay, so that's the more you do that and the more you embrace that, the more it's going to be easier for you to get over on the regulators, because that's what they fundamentally care about. And we want the regulator on side because we want them to be supportive, so that we can come in there and help their companies in their markets scale and provide credit to the real economy. And this goes back to something that Aum had said very much at the beginning. The bricks and mortar banks in their own geographies are not financing in most cases the real economy. It's the fintech lenders, the non-deposit taking financial companies that have sprouted up over the last 6 to 8 years in sub-Saharan Africa. Those are the guys that are financing the real economy right now. Because most bricks and mortar banks in sub-Saharan Africa, I mean, Aum deals with this more than I do, but I had done my fair share of financial institutions in sub-Saharan Africa in my prior life. It's inbound trade finance, it's sovereign debt investment, and
it's all very profitable. You don't need to find
it's all very profitable, but you're not financing
the economy.
Mom and pop. You're not financing mom and pop stores.
Exactly.
You're not financing the taxi driver. You're not financing trade receivables finance companies that move real, fast moving consumer goods through the market. You're just, I mean, that's the real economy, and none of that's being financed by bricks and mortar banks. And so, maybe it's a central bank regulator issue, but it's also a political issue, right? Like there has to be a way to unlock that to allow guys like us in the door.
Definitely. And AJ, one thing I want to ask you is that, which companies, especially in Africa, have you come to admire for especially lending companies that you really respect and you think people should kind of model their business around?
Move is definitely the one that we think they're great. We've tried a few times to partner with them. We haven't yet been able to do that, but we like the model, and we think that they've done a really good job. MCOPE is another one. I mean, these are companies that know what they're doing, and they can act as a nice benchmark for up and coming companies, as it were. So those, that of that ilk, those would be really good poster children, as it were, for the rest of the market at large.
And I think there's a learning in there, which is really important, which I think is, and I don't want to promote ourselves and AJ and whatever too much, but at least the partners you're with matter. And when you're with the wrong partner, it becomes clear really quickly. And what I mean by that is with Move, Lali and Jide, we've known them at TLG since about 2017 or 18. So we've been funding some of their, we've worked with them before and so on. And this was before they started, the ride hailing, or funding for drivers and so on, or doing different things. And I remember one of the things that they were saying to us was, when in Nigeria, as you guys may know, these fuel strikes sometimes happen. And when there's a fuel strike, all the drivers are not getting up 2 hours earlier to queue for petrol stations, are they? They're just going to the petrol station when they start work, which makes sense. You have breakfast with your kids or whatever, and then you start work. And the queues, I'm sure you guys have had the experience. Lagos fuel queue is like a serious thing. Like your day is gone. And if your day is gone, you're not generating revenue. And if AJ and Aum are looking at our dashboard with zero context, because we have our Philippines exposure over there, our South Africa exposure over there, and Nigeria over here, and we call them, be like, guys, what's happening? Can we have an IC meeting like now? This is really important. You're not generating this. You're on your covenants. You're in trouble. Whatever. They're going to look to refinance you as soon as they can. And I think being the right partner, and that comes with obviously everything that we've said. There's a right way to do things. There's a right way to have a system. You need to take your creditors seriously. We're here to get paid, blah, blah, blah. But I think our job is also to understand what entrepreneurs and founders are going through. And when it matters, show them empathy or understand that macro and these sorts of things happen to everyone. And I think it's when you can work with people and you can work through that. Because at that point, it didn't matter if you financed the guy who was doing Bolt drivers or Uber drivers or whatever drivers, they're all in the same thing. That's where working with the client really matters.
No.
So I just want to stay on Move for a second as a bit of a proxy, because like I mentioned before, in other jurisdictions, we're likely to see the first, public securitizations, whether it be a CLO, which is a collateralized loan obligation, or an ABS, an asset-backed security transaction, come out where the underlying assets are originated by fintech lenders. I would not be surprised if Move becomes one of the early originators going into these public markets. I mean, they're at a point. I mean, I have personally known them since early days, and have watched, with amazement as to how they've been able to scale in various markets. But that is a classic case study that we point to many other early stage founders, and we say, look, first you go friends and family, then you come to guys like us, then we help you scale up, and then J.P. Morgan, Goldman Sachs, and everybody else comes knocking, and then we stay involved. Yeah, and so we're trying to bridge the gap between like the 500,000 million mark up to the 50 million mark, kind of thing, to get them to the point where they can be attractive to the JP Morgans and the Goldman Sachses of the world. Franklin Templeton's another one that keeps now popping up, particularly in the Middle East. And then we try to stay involved even beyond that. So you look at a platform like Tabby in Saudi, right? This is a platform that first time then the portfolio was sub $2 million, and they're now closing a $1.2 billion facility with a global investment bank, and it's only been 7 years. And the guys that were involved with them originally, our friends at Partners for Growth, for example, have been involved with them very early on. I don't know if their investment mandate allows them, but if it was me, if I had Sixpoint running at the time back then, I would have hitched my wagon to Tabby all the way through, and then stayed involved in a subordinate mezzanine asset class. As a substitute or an alternative to other types of haircut capital, so that they could reduce the burden on their equity investors when it comes time for them to raise that big facility. And that only comes from when you have built a track record with guys like us over a period of time, that you get comfortable being able to support them when the big guys come knocking, right? So we're also big promoters of mezzanine financing as an asset class in the emerging market for fintech lenders. We're the only ones that are jumping up and down that mezzanine financing is important. There's not that many dedicated funds that do mezzanine finance for emerging market fintech lenders. And it's not something that a very early stage founder should be thinking about, but it's definitely something where if you're going to be going the same trajectory as a Move or a Tabby or an Akolaku or a Credivo in Southeast Asia, you're going to need that.
Got it. Now we're winding up, and I want us to move into like a quick fire section. And so I'll ask a question and ask AJ and Aum just quick feedback. The first one is that what's the biggest mistake first time lenders make when they're talking to you guys? Maybe we'll start with Aum and just keep it short and sweet.
Yeah, I think it's a simple answer. It's selling the equity story to a completely different investor. That's what it is.
Yep.
Yeah, I think it's pitching vision and not performance. We want to see default curves, collection logic, and underwriting learnings. Not buzzwords.
Yeah, and maybe this time we'll start with you, AJ. What's the most useful clause in a loan agreement, and why is this the most important thing for you?
Declining first borrower default rates across cohorts.
Okay, could you just clarify what that means?
We want to see first-time borrower default rates decline as more cohorts are originated, because that tells us the underwriting model is predictive and it's learning. You're not just lending, you're evolving.
Got it. Aum?
Yeah, it's the family of that. So people that don't know so much about English or New York law facility style agreements, you have a bunch of events of default. For me, it's that genre of informational defaults that are the most important, because they bind the borrower to do stuff. They give the lender a way to, accelerate if people don't. And normally you have this concept of a grace or a cure period in the middle that means that, well, now it's time to take it very seriously. Otherwise, you're in default. And I think that's really important. Otherwise, you're just providing liquidity. You're not really lending to a business.
And again, AJ, if you had $1 million left in your bank account and you had to support a specific African lending niche, which one would it be, and why?
Digitized trade credit for informal FMCG retailers. This is a huge market opportunity. It's completely underserved. There's very large demand, and the banks are not providing credit to these people. So you've got things up and down the supply chain. You can go from wholesalers to you can go from big box wholesalers to wholesale distributors to micro distributors. That whole supply chain doesn't get enough. Does not have enough support in credit, and so we like that business model a lot. It's high frequency, it's repeat borrowers, strong supplier leverage, and there's a high velocity, which makes it perfect for securitization.
Got it. Aum?
Yeah, I mean, we met right through logistics, freight forwarding, all that kind of stuff. I think that's a massive space. And the other one that we're trying to learn a little bit more about now is these payments businesses, right? So payments, remittance, floats, etc. There's there's a huge amount of risk if you don't structure it right. So getting the structuring right is really important. So you're only looking at settlements, and you're not looking at potential flows. But that, or I think, look, logistics, freight forwarding, distribution, stuff moving around, that's a huge opportunity.
And it'll always move around. AI won't disrupt that. I don't see AI disrupting that anytime soon. And guys, this has been a fantastic episode. I think the insights, like as we expected, were much more nuanced than you do in an article. You need probably like 20,000 words to kind of accomplish what we did today. So thank you so much for coming on the show, AJ. Thank you so much. And hopefully we'll do another one in maybe 6 months to a year's time and exchange notes.
We should start scheduling now then. Appreciate it.
Yeah, exactly. It's been a busy period, I think, for all of us, but it's been a real pleasure to do this, and hopefully your listeners were able to get some good insight. And I'll speak on behalf of Aum here. We're both readily available to your viewers. This is a space that I think we both feel very passionately about. I know, Aum and I are friends. We've built a friendship over the past few years. Every time I get on the phone with him, it turns into a really passionate discussion about what's going on in the market. This is something we it's not just a job, it's a calling, right? So we really look at what we're doing, and we want to support the growth of formalized credit in these markets, because there's not only a demand, but there's it's a very strong need. So this kind of podcast in particular is very helpful to get the word out. And again, Terry, I'll tell you offline what regulators you should send it to, and to try to move the ball down the field a little bit. But thank you.
Great, man.
Thank you
so much.